Here is a paradox hiding inside one of the biggest companies on earth. In a single 3-month stretch, its cloud business grew 38%, one of the fastest growing large clouds anywhere. And in that exact same quarter, the profit from actually running the business fell almost to zero. Same company, same 3 months, booming on one line, collapsing on another. It is the largest e-commerce and cloud company in China, ticker BABA, Alibaba. And on a simple value screen, it now looks cheap. So here's the honest question worth a few minutes. Is that cheapness a trap? A company whose spending will never pay off? Or a cloud cycle turn caught in the middle? A giant deliberately under-earning while it builds? Let's take it apart the honest way. No buy call, just the mechanism. Start with what is booming, because it is real. Alibaba Cloud, its cloud computing arm, grew revenue 38% year over year to around $6 billion in the quarter. The engine underneath that is artificial intelligence. Alibaba says its AI-related cloud revenue has grown triple digits, more than doubling, for 11 straight quarters. Not one good quarter, 11 in a row. Management now expects AI products to make up more than half of all cloud revenue within a year, and is guiding to tens of billions of yuan in recurring AI revenue by year-end. In a country racing to build its own AI stack, Alibaba has become the default cloud underneath it. That is the bull engine, and the demand behind it is not imaginary. So far, the growth story checks out. But that growth has a price, and here is where the profit went. To win the AI cloud, Alibaba is spending enormous sums building data centers. It committed to a 3-year plan of 380 billion yuan, over $50 billion, for AI and cloud infrastructure. And management has already said it will likely overshoot that number because demand keeps climbing. Its data center footprint is now many times what it was a few years ago. That spending flows straight through the income statement. Now the headline net income actually rose, but only because of one-time gains on its investments. Strip those out, and the profit from the business itself merely vanished. Adjusted operating profit fell about 84%. Adjusted net income dropped almost 100%, down to a rounding error. The company can afford it. It sits on more than $70 billion in cash. But that is why it can look cheap on a screen. The earnings being divided into the price have been deliberately crushed. So which is it? A value trap or a cloud cycle turn? Both cases are real. The bull case? This is exactly what Amazon and Microsoft looked like early. A company under-earning on purpose, pouring today's profit into infrastructure that becomes tomorrow's margin. With 11 quarters of triple-digit AI demand saying the build-out is justified. The bear case? This is a Chinese company that has traded at a structural discount for years. The capex may never convert to Western-style cloud margins, and the stock has actually fallen in 2026 even as the spending climbs. The market is not yet convinced. One side sees a compounding machine being built, the other sees money going into a hole. Both can point at the very same quarter and see the opposite thing. So what would actually settle it? The growth is real. The open question is whether it ever becomes profit. Watch 2 numbers instead of the headline. First, adjusted operating profit, the EBITDA. Does it start climbing back as the capex wave crests, or does it keep sinking as spending rises? That one line tells you whether the investment is converting into margin. Second, that AI recurring revenue target. Does the monetization actually show up on schedule or slip? If margin recovers while the AI revenue lands, the cloud turn was real. If capex keeps rising with no profit in sight, the screen was right to call it cheap for a reason. Right now, it is simply too early to know. A giant caught mid-build. This is educational analysis of public filings, not investment advice. Verify every number yourself before you act on any of it.